As the Q4 2024 earnings season winds down, tariffs are uppermost on corporate executives' minds. In fact, according to published reports, mentions of tariffs on earnings calls have shot higher this earnings season. Our research director, Shiraz Mian, here now to discuss just how tariffs may impact earnings going forward. Shiraz, also, according to those published reports, tariff talk has been noted on earnings calls across all sectors. So do you see this as a major headwind to the S&P 500 index earnings going forward?
Oh, absolutely, Terry. This is undoubtedly one of the biggest worries on the horizon, and unequivocally negative. And it makes full intuitive sense because if our companies, the Targets and the Macy's of the world, if they have to eat up the full extent of the tariff themselves, then that's a hit to their margins. If they partly do that by sharing it with the exporter, then it's a partly hit to the margin. And if they can pass on the entirety of the tariff to the end consumer, that risks affecting their sales because consumers may decide not to buy as much. So absolutely, it's a negative for earnings and has emerged as a major headwind lately.
So it's safe to say then at this point that it should impact the entire S&P index, not just certain sectors?
So yes and no. Yes, in the sense that the associated uncertainty with all this tariff talk, like we have to keep in mind that up to this time, it's for all practical purposes just talk of tariffs and countermeasures from our trading partners. There's not a whole lot concrete on the ground. So all of this uncertainty is a problem for everyone in the economy, but not everyone is exposed to tariffs to the same extent. The Macy's and the Targets of the world are a lot more than the Meta and the Alphabets of the world. So the uncertainty is a problem for everyone. To the extent that we do end up in a world dominated by tariffs, some sectors will be hit more than others.
So in the event that the tariffs become real, percentage-wise, what might this mean for earnings growth this year, and how might that differ from what was originally expected prior to the tariff talk?
Yeah, so that's the million-dollar question, Terry. And it's you in order to answer what you're asking for, which is you're asking for concrete numbers, you have to make some simplifying assumptions. So historically, the U.S. hasn't had a lot of tariffs. So on average, less than 2% has been the effective tariff rate in the U.S. So there have been calculations that say that if you increase the effective tariff rate across the economy, barring Canada and Mexico, by 5 percentage points, then that'll have a negative effect on S&P 500 earnings ranging from -1% to -2%. If you include Canada and Mexico in it, and the effective tariff rate goes up to, say, 10%, then that's a further hit to S&P 500 earnings by the same magnitude. So anywhere 1 to 2% or 2 to 4% negative hit to S&P 500 earnings in the aggregate.
Okay, and to just clarify what we've already talked about, so the retailers reported at the end of this current earnings season. So, and from what I'm hearing you say, that is the sector that may be most affected.
Absolutely. So think of a Best Buy store, and whether you're looking at a smartphone or a laptop computer or a computer printer or some other household appliance, you can reasonably assume that pretty much all of those electronic products are coming from outside of the U.S. And to the extent that the countries of origin will be dealing with tariffs, then pretty much the entire merchandise within the Best Buy store will be exposed to those tariffs. And the headwinds that we noted earlier in terms of the potential margin impact or the potential sales impact, Best Buy will be faced with the full extent of that. And then from Best Buy, which is at one extreme, you could go across the value chain to the Targets and the Walmarts and the Macy's and the Kohl's. It's a varying amount of the merchandise that comes from abroad, and depending on the countries of origin, the proportion of the merchandise that comes from those countries, and to what extent and for how long that merchandise under tariffs, there will be an impact on their profitability. Now, Meta, Facebook, it's all up in the cloud, it's in the internet, it's a service. They have none of that issue. To the extent that they have an issue, it is if Best Buy, since its business will be affected, will not advertise as much on Meta's platform. So more of an indirect effect. But yes, retail is a lot more in the eye of the storm, if you will.
And this just came to my mind, so I'm just going to follow up with, what about the autos?
Absolutely. So the autos have been really in the midst of it all. We're all getting to understand the supply chains for these autos a lot better now. As of this time, it appears that the sector has been carved out, at least temporarily, from all of the negotiations that's going on with the Mexico-Canada partners. But it's still up in the air as to what the extent of the tariff equation will be in the long run. But it's a big problem for autos. They are heavily dependent on imports for components and the finished product from Canada and Mexico. And if that's a trade regime we are heading towards, then that's an issue for automakers and also the end customers as a result.
All right. What story is your scorecard telling us about growth, margins, and all that stuff?
So effectively, as you know, Terry, the Q4 earnings season is now behind us. There's just a handful of these truly laggards that have still to report. But for all practical purposes, we are done with the earnings season. Earnings were up a very impressive 15.1% in Q4. Revenues were up 5.7%. 76.2% of these companies beat EPS estimates. 65.1% of these companies beat revenue estimates. Relative to the recent history, you see that the earnings and revenue growth that we saw in Q4 represents a pretty notable acceleration in the growth momentum. The beats percentages were kind of a bit on the light side, but totally within the historical averages. Margins have been at, as I noted, 15% earnings growth and 5.7% revenue growth. So pretty much all of the remaining earnings growth beyond the 5.7% top line growth came from margin expansion, which is very impressive given where we have been in the cycle.
So what are you looking for growth-wise for Q4 bottom line versus Q1 of 2025?
So there is a deceleration in the growth trend, Terry. The Q1 25 earnings. Now, just stepping back before I directly answer your question, there is a seasonality element in corporate earnings. So Q4 packs a big punch, a big chunk of S&P 500 earnings arrive in Q4. So Q4 is a big deal for retail, as we were talking about, tech and a few other sectors. Q1, on the other hand, is the seasonally low point. So we have very strong growth in Q4, 15.2%, as we were talking about. It's expected to drop down to a little over 6% earnings growth in Q1. And the revisions trend since Q1 got underway on January 1st has not been that reassuring. Estimates have been coming down a lot more relative to what we have been seeing in the last few quarters. So about 6% growth is expected in Q1, and when we close the books on Q4, it'll be a little north of 15%.
You wrote recently that the outlook for tech earnings is beginning to shift. Is that also due to tariff talk? What's up with that?
Not so much tariffs, Terry, though that just adds to the, as we were noting earlier, that just adds to the aggregate uncertainty factor in the macro, to which then tech is also exposed. But you would recall that one of the big trends in tech in recent quarters has been this very heavy spending on building out the infrastructure for artificial intelligence. And then at the beginning of the year, we found that there was this Chinese startup that had seemingly a better way, a more efficient way, a more cost-effective way of getting to the same endpoint. And it's these questions about the very heavy capital spending, AI-centric capital spending by these tech giants. That's been a recurring theme about the tech sector for a while, and that issue appears to have become a lot more front and center for the group. So I'm not saying the tech sector is completely segregated from this tariff talk or has no exposure to the issue at all. The hardware side of technology, as we all know, is heavily dependent on international trade, and whether it's computers, as we were discussing in the context of Best Buy, or smartphones from Apple's or anyone else, all of those products come from abroad, and to the extent they are exposed to that, there's a problem. But it's this seeming question marks and uncertainty about the overall AI-centric spending outlook that seems to be weighing on the earnings outlook for tech, and that's problematic for the market as a whole because the tech earnings outlook has been consistently positive over the last 4 to 6 quarters, and if that turns, that, in my judgment, will be a big headwind for the market as a whole.
All right. As the Q4 season then moves into the rearview mirror, overall, what are the major takeaways?
So, as I noted earlier, Terry, there is a very favorable and positive growth momentum if you look in the rearview mirror at Q4 and how Q4 stacks up relative to other recent quarters, both in terms of earnings, revenues, and margins. And before this tariff talk really became tangible after the middle of the Q4 earnings cycle, The general tone and tenor of management commentary about trends in their business was also favorable and reassuring. So the key takeaways, there is this question of uncertainty about what's in store for us on the tariffs front, what effect that has on the macro economy in terms of the growth outlook, GDP growth, and to the extent that there are questions about that, uncertainty about that, and even some worries that perhaps the growth momentum isn't as entrenched and strong as many of us have taken for granted, that has implications for earnings outlook in the coming periods. And that's not a positive and good place to be in for stock market investors.
All right. We want to remind our listeners that they can always get updates on your thoughts on the earnings trends and issues in your written commentary, and that's available on Zacks.com. It gets updated twice a week, once on Monday, once on Thursday. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.